you think Tesla stock will soon receive the good news that is a long time coming? Tesla undeniably has had a rough year and is only beginning to show signs of improving. But is it actually finally happening? Make sure not to miss this. Even when Tesla stock was way down last year, some think the automaker could have a sizable upside in the future. Many analysts view Tesla's low stock price as a chance to see serious value growth, including investment firm Morgan Stanley. Morgan Stanley called Tesla one of its top picks for 2023 in early December, highlighting increasing competition and the company's dominant position amidst a bear market, as detailed in a report from Teslarati. The firm also maintained a price target of $330, while some other analysts have dropped their own targets on Tesla stock. While we see 2023 as a challenging year for the EV market categorically, we believe Tesla's gap to competition can widen, wrote Morgan Stanley in a note to clients. In fact, Morgan Stanley remains bullish on Tesla stock despite recent turmoil and worry over Elon Musk's focus. In a recent client note, longtime Tesla proponent Adam Jonas cut his price target on the stock to $250, down from $330 previously. But despite the mea culpa, his new forecast still calls for a 122% upside from its current share price of just under $125 in early January. Jonas's objective is almost identical to the street's average target, which stands at $251.48 and is set to generate gains of 104% over the coming months. According to data from TipRanks, the stock claims a moderate buy consensus rating based on 20 buys, 9 holds, and 2 sells. Jonas offered 2 main reasons for his continued optimistic outlook. Tesla will extend its existing lead versus electric vehicle competitors and also see benefits from the Inflation Reduction Act. When addressing Tesla's more than 65% drop in 2022, including a 40% plunge in December alone, Jonas stopped short of blaming CEO Elon Musk's preoccupation with Twitter, something that a growing chorus of critics has pointed to as a major loss driver. He instead attributed it to supply outpacing demand for the first time since the COVID-19 pandemic, and assorted technical factors. The last 2 years of demand exceeding supply will be substantially inverted to supply exceeding demand, Jonas wrote. Within this environment, we believe players that are self-funded, not reliant on external capital funding, with demonstrated scale and cost leadership throughout the value chain, from manufacturing to upstream material supply, can be relative winners. He continued, between a worsening macro backdrop, record-high unfavorability, and increasing competition, there are hurdles to overcome. Yet we do believe that in the face of all these pressures, Tesla will widen its lead in the EV race, as it leverages its cost and scale advantages to further itself from the competition. That said, while other investors are worried about Tesla's latest mispiling on top of a slew of bad news, some actually see the EV giant as positioned well for the year ahead. In early January, when Tesla reported production of 439,701 vehicles and delivered 405,278 in the fourth quarter of 2022, short of Wall Street's expectation of 431,117 deliveries for the period, several investors aren't thrilled to see Tesla's numbers fail to meet expectations and that vehicle supply outpaced demand yet again. However, others who watch the company closely aren't as concerned about all of this. Morgan Stanley's Adam Jonas, for one, remained confident in the EV maker last week, as mentioned earlier. Well, big changes are going on in the global electric vehicle market, where once there was a severe lack of supply, it is now swinging the other way, which could potentially lead to a plethora of supply. This is the opinion of Morgan Stanley analyst Adam Jonas, who believes 2023 will be a year during which execution on manufacturing cost and supply chain management will further separate the winners from the challenged, to bring about more affordable electric vehicle prices that will facilitate further penetration. Both will be needed. As expectations get a negative reset, capital self-sufficiency could also be tested. In fact, as investors, buyers, and regulators consider the unseen cost related to moving away from a Chinese-dominated EV supply chain to a market where many players have yet to prove the viability of the business model, Jonas thinks that over the next few years, the rate of exchange of EV penetration could potentially turn out to be something of a letdown. The upshot of all this preamble is that there is one company better positioned than others to forge ahead as the undisputed EV leader. Within our coverage, says Jonas, we believe Tesla is uniquely positioned to lead engineering and cost improvements that have yet to truly unlock the scale potential of the EV economy. Investors should plan for a greater deflation in the EV space over the near term, with a negative reset to margin expectations, while Tesla could trade in a volatile, sawtooth-like range for a while before investors get more at ease with a floor in the stock's valuation. Jonas thinks a floor in the earnings must be reached. The Morgan Stanley position is viewed as cautious optimism, and it comes ahead of Tesla's plans to begin producing the Cybertruck in 2023 and on the heels of the company's first semi-deliveries to PepsiCo. Tesla also plans to announce another factory around the end of the year, according to Musk, which recent reports allege will be unveiled in Mexico in early 2023. Additionally, Tesla is still ramping up production at its new Texas and Berlin-Brandenburg gigafactories, the latter of which also added an extra shift to its schedule this month. With new products and growth on the horizon, it could be a stock worth watching in the new year. Morgan Stanley is not the only group that remains bullish on Tesla's position. Even as Tesla's stock slid to its lowest point earlier in 2022, Goldman Sachs maintained its buy rating and reiterated a price target of $333. Furthermore, market analysts from Forbes and The Motley Fool have continuously reiterated that Tesla stock's strong fundamentals will likely propel it upwards in the new year. Further, in early January, Deutsche Bank analyst wrote in a note that despite Musk's company coming up below forecasted numbers, both production and deliveries represented all-time records. The firm delivered 1.3 million vehicles in all of 2022. Because of this, Deutsche Bank says Tesla's results are solid in the midst of challenges such as COVID lockdowns in China, supply chain constraints, and macroeconomic issues, and that Tesla remains in the best position for 2023 growth. We expect challenging headlines around demand softening and associated price cuts to continue, Deutsche Bank said. But the company remains best positioned to weather the current macroeconomic conditions, leveraging price to support volume growth while using various cost levers to protect margins. Tesla is among one of the best positioned companies in our coverage to weather weakening consumer conditions, the analyst added. Consider the multiple levers Tesla has in its possession to boost growth while protecting margin in 2023. Even Garrett Nelson, VP and Senior Equity Analyst at CFRA Research, reiterated his strong buy opinion on Tesla shares. After a difficult year for EV manufacturer equities such as Tesla, Lucid, and Rivian, we are bullish on Tesla in 2023, Nelson wrote in a research note. Nelson said he expects a potential stock buyback and momentum as a result of lower-priced versions of the Model 3 and Model Y becoming eligible for the $7,500 federal EV tax credit. Nelson also expects new record-high volumes for Tesla as it continues to ramp up production in Austin, Texas, and Berlin. However, some analysts predict that the tech stocks could still fall, causing a level of caution among investors. Another factor affecting stocks across the board is the precarious nature of the current bear market, as the U.S. Federal Reserve has pushed interest rates upward to combat inflation. In light of this, Wedbush securities analyst Dan Ives has been vocal with his concerns over Tesla in recent weeks. He even said the results are indicative Tesla continues to grow. On one hand, in this softer macro, with automakers struggling on the demand-supply front, these numbers overall paint a picture of a company growing rapidly on the EV front, and still in the early innings of a major growth cycle. Ives wrote in a note, however, Tesla is held to a higher standard, and a miss is a miss, and the bulls are not popping champagne on these numbers. Regardless, Wedbush is maintaining an outperform rating for Tesla. These numbers could have been worse in the eyes of the street, Ives said. That said, the Cinderella ride is over for Tesla. In any case, there's no way to predict what Tesla stock could do in the coming months. Several analysts and Tesla CEO Elon Musk himself have even called the stock inflated at times, and bearish investor expectations have become common on Wall Street in recent months. However, those who already hold the stock and plan to wait out the recession could be in for a long-term opportunity, while other bulls point out the low buy-in price for Tesla shares. Still, going into the new year, many are hoping for a stock recovery from the EV leader. While that likely won't happen overnight, many analysts remain hopeful for the company. Subscribe to Tesla stock for more news.